Welcome back, finance enthusiasts. Let's begin this final segment in the SIE series. This next section will explore different approaches for clients who either choose or decline to make a portfolio correction. Buy and hold. Any investor following the buy and hold strategy will not alter their asset allocation. By not restoring the original strategic asset allocation, transaction costs and tax consequences are minimized since there's no selling or buying of assets. Additionally, the portfolio retains assets that may be steadily appreciating. However, one issue with the buy and hold approach is that, as the asset mix drifts, its risk-reward profile changes. Specifically, its volatility, as measured by the portfolio's standard deviation, may diverge significantly from the original allocation. In fact, the difference might become so considerable that it no longer aligns with the client's risk tolerance. Portfolio rebalancing. Portfolio rebalancing involves periodically buying and selling assets. Through rebalancing, the original strategic asset allocation and its risk-reward profile can be restored. Adjustments may be based on either a time schedule or a value threshold. If time is the focus, rebalancing can follow a predetermined schedule, such as monthly, quarterly, or annually. Conversely, if adjustments are based on value changes, rebalancing occurs when an asset class grows or shrinks beyond a set tolerance level from the original allocation, for example, plus 10%. More frequent rebalancing keeps a client's portfolio closer to its strategic allocation. However, it also results in higher transaction costs because assets are bought and sold more often. Both buy and hold and systematic rebalancing assume that markets are efficient. In other words, it's impossible to time market changes to gain advantages, which aligns with the efficient capital market hypothesis. Indexing. Investors who believe in the efficient market hypothesis and find market timing ineffective often favor buy and hold strategies and invest through market indexing. Indexing involves either holding investments in companies that are part of major stock or bond indexes or directly investing in index funds. Examples of indexes include the DJIA, the S&P 500, the S&P 400, or the Russell 2000. An actively managed fund seeks to outperform a relevant index through superior stock picking, but index composition changes infrequently. Generally, index fund managers trade less often than active managers. As a result, indexing typically incurs lower trading expenses and has fewer tax liabilities passed on to shareholders. Active strategies. Investors who believe markets are not perfectly efficient may use active strategies, such as market timing, to adjust their portfolio's asset mix to capitalize on expected economic developments. This approach, called tactical asset allocation, involves making strategic shifts based on market outlooks. For example, if a portfolio has a mix of 35% large cap, 15% mid cap, 10% small cap equity funds, 30% bonds, and 10% money markets, and the investor believes small cap stocks will outperform, they might increase the small cap allocation from 10% to 15%, reducing other holdings accordingly. If the small cap sector performs well, they can then sell some of that asset and reallocate. Essentially, the goal is to identify sectors likely to outperform and invest accordingly. Sector rotation. Sector rotation is an investment approach that involves shifting money from one industry or sector to another to beat the market. Since different sectors perform well at different stages of the business cycle, this method allows investors to profit as the economy transitions from one phase to another. The economic cycle typically includes early recession, early recovery, and full recovery. Although the length and severity of these phases vary, this is the general pattern. Certain sectors tend to outperform during specific cycle phases. For example, during early recession, utilities usually perform well, while airlines tend to underperform as discretionary income decreases. A portfolio manager employing sector rotation seeks to anticipate the next business cycle phase and reallocate assets to sectors that will benefit most. For instance, if a recession is ending and recovery is beginning, the manager might shift funds into sectors like durable consumer goods, automobiles, appliances, etc., which tend to profit during that period. A dollar cost averaging. Once the best assets to purchase have been selected, investors might opt for a systematic investment approach. With dollar cost averaging, an individual invests a fixed dollar amount at regular intervals, regardless of the security's market price. This fixed dollar strategy avoids trying to predict the perfect time to invest. An investor using dollar-cost averaging can buy more shares when prices are low and fewer when prices are high. Consequently, the investor's average cost per share becomes lower than the average of the purchase prices. This approach does not attempt to time the market. Instead, investors buy shares whether the market is high, low, or somewhere in between. It aims to remove emotion from investing and recognizes that markets can swing unpredictably. Hedging. Once the assets are allocated into a client's optimal portfolio, the client may ask, "Are there ways for me to reduce risk?" For many, the answer is yes, and this is called hedging. Hedging, or protection, essentially involves the client buying insurance to guard against market downturns. Equity options. If an investor already holds a stock position, an equity option can serve as an effective hedge. For example, if an investor has a long position in a stock, she might buy a put option, which offers protection against a potential decline in the stock's value. A put option provides the right to sell the stock at the strike price if the stock drops in value. Conversely, if an investor has a short stock position, she might purchase a call option to protect against a possible rise in the stock's price that was sold short. A call option grants the right to buy the stock at the strike price to cover the short position. Index options. While individual stock options are useful for protecting specific holdings, there's an easier way to hedge an entire portfolio against risk, buying put options on a broad index such as the S&P 500. If the index drops below the strike price, the value of the options increases. This acts as a blanket policy covering the entire stock portfolio. For more concentrated positions, investors can buy put options on a specialized index to provide targeted protection. Currency options. Currency options let investors take positions based on the value of foreign currencies relative to the US dollar. These transactions are settled in US dollars, meaning no delivery of foreign currency is involved. In the US, options are not available on the US dollar itself. Instead, traders take positions on foreign currencies against the dollar, with gains or losses depending on the inverse relationship between the foreign currency and the dollar. For example, a US importer needing to buy goods from France might use currency options for hedging. Oxy Importers, based in the US, plans to buy goods from a European company and pay in euros. If the euro appreciates and the dollar weakens, costs will rise. To hedge this risk, Oxy might buy euro call options, which increase in value if the euro gains strength, offsetting higher costs. Conclusion. This wraps up the SIE learning series for the exam prep. Students are encouraged to review their notes and discuss questions with peers before taking the final tests. Good luck with your studies and your future in finance. As we finish this series, please support us by liking this video and subscribing to our channel for our next series. It only takes a moment, but it means a lot to us, and it's completely free. Remember to turn on notifications so you're the first to see the next segment. Thank you.